Well, welcome everyone to our webinar, Navigating Today's Market. I'm Mindy Cook with Elevation Wealth Partners, and we are thrilled to have you here. So thank you so much for coming. I know all of my favorite clients are watching this, so it really shows that you care about your financial future. So before we dive in, let me introduce my incredible team. Angie Hundt, our business partner who keeps our operations running smoothly. I often refer to her as the genius behind the curtain. Say hi, Angie.
Hi, I'm not so sure about that description, but I'm happy to be here and appreciate it.
Yes. And we also have Amber Wagman, our newest client servicing associate who ensures you're always taken care of. We are so excited to have her. She's such a great addition to the team. So say hello, Amber.
Hi, everybody. It's great to be here and it's nice to meet you. I look forward to, I guess, meeting everybody shortly and working with you.
Yes. And then last but not least, we have Trevor Shultz, who is our investment and economic consultant. Yes, he is the smarty pants of the group. Say hello, Trevor.
Hi. Good to meet everybody. Excited to be here.
All right. So Trevor is going to kick us off by explaining what's happening with President Trump's new tariff policies and the potential impacts on the market. And then Angie and I will explain what this means for you and your portfolio and some actions that you can take right now. So with that, Trevor, can you tell us what's going on right now and explain what the tariffs mean for us?
Yeah, thanks so much, Mindy. Let me go ahead and share my screen and get everything pulled up. All right, so our current situation, as Dave talks about, oftentimes being in the stock market can feel like a roller coaster, filled with optimism and then terror, a little bit of uncertainty, and then you throw in tariffs. And so what we've been through really the last specifically couple of weeks can feel quite a bit like a roller coaster, trying to throw you off. And so there's been a lot of movement, up, down, around, sideways, and all around. So, and what's the cause of that? A big part, and really the main cause has been tariffs. And so we really saw a lot of volatility, a lot of movement happen specifically over the last week. Starting at the beginning of April, Trump came out and announced tariffs, really worldwide tariffs, and a much larger tariff implication than what was anticipated. And so tariffs was really a way to shape up global trade. And so that was a big cause of what we saw with movement in the stock market as well as the economy. And so what are tariffs? Really, tariffs are taxes placed on imported goods by a country's government. Probably the simplest way I think I can describe it. I have three children, and so one of the ways that they tend to make money is, set up a lemonade stand. And so if you can imagine, if you have children or if you've seen a lemonade stand, somebody can set up a lemonade stand and maybe sell a cup of lemonade for, let's say, $1. Say they're doing pretty well with their business, and every weekend they kind of sell lemonade and get $1. And maybe word spreads, and a kid that is in a different city comes over and finds out, hey, this is the place to sell lemonade, and he goes into your child's neighborhood and right next to them, even though it's an HOA, and he decides to start selling lemonade for, instead of $1, for 75 cents. And so now all of this business starts to come to him, and protest. You say, hey, this isn't fair. He's coming, from a whole different area into my area. He's selling, the same product for a lesser amount. And you petition your HOA. You say, hey, you should charge him 25 cents for the opportunity to do business, charge it on his lemonade or charge it on this area to make competition fair. And so that's one of the basic ideas of what a tariff can do, is ideally it can help trade or help businesses to be more fair or more in line. So how did we get to where we are currently? So we know what tariffs are, but Really, we got to our current state of affairs with tariffs in early February. Now, Trump has campaigned on tariffs. It was one of the main things, but we really started to see it get executed in early February. And so, February 1st, Trump signs an executive order, and it was 25% tariffs on Mexico and Canada, which are really outside of China, our two largest trading partners, and caused quite a stir. But only a couple days later, we see him enact a 30-day pause on Canada and the Mexico tariffs after there was a couple border concessions, some desire for increased security over fentanyl, and now a lot more negotiations have happened. Um, the second main one was what most of you probably are aware of, or at least noticed, was April 2nd, where it was the 10% universal tariffs, and there were higher reciprocal tariffs. And that was the big thing that caused a lot of stir is these higher reciprocal tariffs would have increased the tariff rates to the highest in over 100 years. And so China would have gotten bumped to 54%, the EU 20, and several other nations. And we saw a lot of movement as a result of very large surprise for that. But just like we saw with Mexico and Canada, about a week later, a little less than a week later, and right as the reciprocal tariffs are going into effect, Trump says, we're going to pause this for a 90-day tariff or a 90-day pause on the tariffs, on the reciprocal tariffs. The 10% universal is still there, except for China. China is now at a 145% tariff, and so we're very much in a standstill with China right now and trying to figure out what that's going to look like. So that's where we are and kind of how we got there. But why? What are the potential benefits and risks from tariffs? So some of the benefits or the opportunities from tariffs is that tariffs can have the potential to boost domestic industry. Right? Tariffs can make foreign goods pricier, just like that illustration of, the lemonade. It can make businesses more fair so that people want to buy from domestic products more for the U.S. So it can encourage purchasing American-made products, supporting local jobs. Tariffs can also give trade leverage. It can give the U.S. bargaining power to push for fair trade deals. If there are bad negotiations or bad trade deals that were set up, then these tariffs can ideally allow for renegotiating and coming up with better deals for both parties. Tariffs can also allow for national security. Tariffs on key materials like steel reduce reliance on foreign sources, vital for defense and infrastructure. Have seen that with China of reducing certain ships or military that have gone over, or making it so that we don't trade on those. So those are some of the potential benefits from tariffs. But what about some of the potential risks? Now, tariffs have the potential risk of increasing prices. Tariffs raise costs for businesses, which often means higher prices for consumers. And economists debate whether that's just a one-time price hike or whether that can be baked into a longer term. But at least for a moment, prices are increased as a result. One of the other risks is foreign retaliation. Other countries can respond with tariffs of their own, which will hurt U.S. exporters, and you can get into a tariff war, tit for tat. And we saw this initially with the EU. They had retaliatory tariffs. We put our pause on with the hopes that that will be reconciled. But we're kind of in this current environment with China, where we are still, we raise their tariffs or we raise tariffs on them. They raise tariffs on us, and back and forth until we're kind of at this standstill of trade. One of the other risks is business uncertainty. So frequent tariff changes create instability, making it hard for companies to plan ahead. And it's hard for a business to think, I want to hire or I want to plan to make this large acquisition or purchase or start a new industry if they're not exactly sure what prices are going to be for different components that they're building. And so it can slow business growth. And growth overall in the US is determined by GDP, or gross domestic product. It's kind of like the US's income, how we measure how it's growing. And usually the US economy, at least for the last 10 years, has grown around 2.5%. 2.5 to 2.8% is a pretty average GDP. And what we're seeing is potentially, we don't know exactly how all the tariffs are going to shake out in their full form yet. but potentially GDP might decline by 0.8 to 1%. So that would mean that we would still have positive GDP, somewhere around 0.5 to 1.3, but it would be less. It would be much slower GDP once we kind of see if tariffs in their current form hold true. Now, that's a slowdown, but just to put it in perspective, two other really large financial crises that we went through. 2008, our GDP contracted. So it was not positive, it was negative, a full negative 4.3%. COVID, remember when the entire world economy shut down? The first quarter in 2020, GDP fell at negative 7.3%. So we've been through much, much worse than what the tariff implication is. Is this going to bring changes to the world economy? Yes. Are there going to be implications for growth? Yes. But I think it's important to keep some of those in perspective when we think about what other things have happened that have impacted growth. Another really important thing to keep in mind is how much the US economy is, built on, or how much consumers spend on imported goods. So most of what consumers spend in the US, 70% of what we buy is services. Most of what we're spending money on in the US is services that has no impact on tariff. The other 30% of what we spend money on is goods. But only 30% of that goods that we're buying, only 30% of that is even imported. So, that's a lot of percentages, but the baseline is about 8% of what we buy, about 8% of what we spend money on is actually going to be impacted by tariffs. So, is it going to have an impact? Yes. But I think it's important to keep these things in perspective. Another thing to realize is, so this chart, it's showing exports as a share of GDP. And what this means is you're going to see five different things: the United States, China, Japan, Canada, Mexico, Germany, sorry, six. And what this is saying is how much of our GDP is from trade, from sending out. And so it's just showing how much a tariff's going to have an impact. 11% of the US's GDP is generated by what we trade with us, or what we send out to other people. Now, that means that other people's tariffs aren't going to impact us nearly as much. When we look at China, Japan, Canada, Mexico, Germany, tariffs have a much, much larger impact on their growth as an economy because need need the US to buy more. They need us to buy their goods to generate their economic growth. So I think it's just helpful for us to keep in mind the impact of tariffs and what they will do for not only our economy, but for others' economy as well. And I think one of the other potential risks is trust in the U.S. partnership. So trust in the U.S. dollar, U.S. currency, trading relationships can deteriorate, leading other nations to form new trade relationships, hurting the U.S. And so that is one of the risks, and it is good, I think, to see the 90-day pause, so that hopefully we can form better trade relationships and keep strong partnerships rather than others creating trade routes outside of the U.S. One of the other risks is kind of what we've seen, but volatility. One of the things that happens in periods of uncertainty is that people can get afraid. And so this measures the VIX, or the volatility index. And this is year to date, right? January, February, March. We're kind of clipping along right underneath that 20 mark, which is pretty stable. That's not really much volatility at all. And you start to see tariffs start to take impact, and we go down. And then this almost parabolic straight upward climb is from the announcement that Trump did about the universal tariffs. And so it climbs up and actually goes to almost over 60 before dropping back down. Another way to see that is through the NASDAQ. So this is the NASDAQ. This is an ETF. It covers a lot of technology stocks, and so it moves a lot. And this just shows you over the last month its price. So it's actually positive. And then we see the announcement with tariffs, and we see a very sharp decline. But as soon as Trump announces the 90-day pause, we see the largest daily increase since 2001. So we've not seen a jump like that in a day, where it jumps 12% in 24 years that it jumped up. And then, it kind of is going sideways now. So those are a little bit of some of the risks where we're at. And I'm going to go ahead and hand it off to Mindy to talk about some healthy responses. What should you do in light of what's going on?
Thank you so much, Trevor. That was a lot of information, but I think it helps see behind the scenes when you can understand kind of some of the macroeconomics and the strategies behind there, and then how does it correlate to the market, and then ultimately your portfolio, right? So now that you have that base information, what should you do? What are some healthy responses that you should have? And we do want you to be informed, but we do not want you to be obsessed. That's our whole goal, right? So here are some typical reactions listed that a lot of people would have when it comes to a volatile market. And we're going to do our best to steer you away from those by educating you. So a lot of people, of course, get anxiety and stress, right? That's no secret. So if they're constantly, logging into their account or seeing what their balance is today, that can trigger emotional swings and, keeps your brain in overdrive, and it can really hurt your sleep and your focus. Obviously, we don't want people to have a short-term focus. If someone was to fixate just on the headlines, especially on a daily or weekly basis, that could really forget about their long-term goals and overreact to short market blips. People also can make emotional decisions during times like this. So, fear and greed really drive rash moves like panic selling or chasing trends, which often lead to losses. And then information overload is probably the biggest thing that we would try to steer our clients away from, right? There's information everywhere, social media, news outlets, TV, radio, friends, family. And so, what we would encourage people to do is find a couple of credible resources, listen to them maybe for a couple minutes a day or whatever your time frame is. Maybe even set a timer so you don't bombard yourself. We want you to, again, be informed but not obsessed. We certainly don't want you to neglect, short term, your life, your attention, crowding out relationships, your work, and what you're supposed to be doing on a daily basis just because of short term volatility. Okay. All right. So what you can do is review your goals and time frame, which not only you come into play, but so does your financial advisor, right? So you can review your goals. What do I need this money for? For most people, when we're talking about that, that does look like retirement. Okay. Maybe you have other financial goals as well, but for most of us, that's that long-term goal. And then the time frame is, when will I need this money? Okay. For those who are younger, obviously it's going to be probably further away if we're talking about retirement, or there may be, people who are in retirement or very close to retirement. So your portfolio is really based on those two things, time and goals. So if either of these things changes, then we need to change your portfolio. We don't react to short-term events, but that's why we try to keep in contact so often, is so that we can make sure that those two things are aligned and we can review those often. Okay. So now, Angie, talk to us about how portfolios are constructed.
Mhm. So the most important thing about your portfolio is that we keep it diversified. And I know we all hear that term all of the time, but we wanted to dive in a little bit into the specifics of that. So first, what we're going to look at is holding US stocks versus international stocks. So Dave talks about having that component of your portfolio that's international. And, we've been on a long run of US outperforming international. And so sometimes it's hard to really understand why we want to continue to hold that international, but it's important to look at the long-term trends. Because as this chart here shows, in purple are the years that international actually outperformed the US. And then gray is when the US outperformed international. So as you can see, it's cyclical. And so we take that into account when constructing your portfolios, that we know we're going to go through these cycles where one is going to outperform the other. And so we always want to hold some of everything. As recently as the early 2000s, international outperformed for 7 years. And it's easy to forget that, but that really wasn't that long ago. And so just because we've had a long trend of the US outperforming, we really want to take a historical perspective on this and recognize that there's a good chance we're going to see international outperform again at some point in the future. And so we want to continue to hold that. And the next, going into the buckets a little deeper. So Dave talks about holding the international bucket, the aggressive growth, growth and income, and the growth bucket. And so we have each of those in a portfolio. And, in recent years, that growth bucket, the S&P, the NASDAQ, that has really outperformed. But again, looking at a historical perspective, this chart here shows the years from 2000 to 2010, which is known as the lost decade, where the S&P 500 did terribly. And again, that wasn't that long ago. So if we look at the performance during those 10 years, international was at the top with 46% returns. Aggressive growth, which is like our small and mid-sized companies, was next at 31%. Our value or growth and income bucket was nearly flat. And then the S&P 500 lost 21% and the NASDAQ lost 46% over those 10 years. So we have to keep in mind that we're going to see these fluctuations, and that's why we have to continue to hold all of the different buckets and stay diversified because we don't know what areas are going to see outperformance. And so we want to make sure we have exposure to all of them. And then finally, if we just zoom out and look at like the total historical perspective of our stock market, this chart goes back to 1900 and shows the ups and downs of the stock market, the recessions we've had. We've got the Great Depression on here, a bunch of wars, the global financial crisis in '08, the COVID crisis in 2020. But what you can see when you zoom out is that we continue to have an upward trajectory. So when you're in those moments and you're looking at the 1 year or the 3 year or the 5 year, it can feel like this is a crisis, I'm never going to recover from this. But you really need to be looking at this in terms of like a generational timeline or your personal timeline. What is the likelihood that we're going to go through these downturns on a regular cycle? It's pretty high. But as we can see from history, we also have recoveries and continued gains. And so it's helpful to look at this further zoomed out history when experiencing times like we are right now.
All right, very good. So, what actions can we take? We definitely want to be a buyer and not a seller of stocks when there's fear. So, Charles Ellis says, when stocks get cheaper, how can that not be good news for a long-term investor? Which we all are, right? There are very few times when you should be bold, and history shows that those times are precisely when it seems you should be most afraid. It's absolutely crazy to sell stocks after they drop. Instead, you should say, today there's a first-rate bargain and I'm buying. Colin Roach says the stock market is the only market where things go on sale and all the customers run out of the store. Let me just break it down into Mindy terms for you, okay? Ladies, let's say that you're in Sephora and they announce a 50% off sale. Are you going to run out of that store? No, you're going to get a bigger buggy and you're going to put all the stuff in it, right? Same with the stock market. When there's a sale, we should be buying more. Men, I'm not leaving you out. When you go to Home Depot and you're in there and they announce sales on tools and such, whatever, right? Then you should say, well, I'm going to get another basket. I'm going to make my wife happy and fill them up with tools. So same concept here. Shelby Davis says a down market lets you buy more shares in great companies at favorable prices. If you know what you're doing, you'll make the most of your money from these periods. You just won't realize it until much later.
So this is a really great chart comparing four investors and their hypothetical actions when we had the 2008 financial crisis, which I'm sure we all remember, and that was a period of extreme volatility and downturn in the market. So let's say we have our four investors, they all started with $10,000. And at the bottom, we have the apprehensive investor who was like, this is just too much volatility. This is crazy. I can't deal with it. I think we can all relate to having those feelings sometimes. And they were just like, I'm going to get out, go into cash where I know it's safe. Well, the problem is their $10,000 in cash is now worth $6,100 because of inflation. So in the long term, that's not a great move. Let's say we have the uncertain investor who had 10 grand and was like, I don't like this. I'm going to pull out for a bit, let things settle, and then get back in a year later. Okay. They end up with 32,000. But who did even better was the steady investor who said, I'm going to withstand the volatility. I'm going to let the market do its thing. I'm not going to touch anything. And they just stayed the course. They ended up with 40 grand at the end of this. But then what's extra fun is our opportunistic investor who said, stocks are on sale, I'm buying, right? So they put an extra 10 grand in when this was all happening. Their portfolio is now worth $106,000. Like that previous quote said, these are the times where you make the most money, but you just don't realize it until a lot later. And that is very clearly illustrated with our hypothetical investors here that went through the 2008 crash. And then finally, our last chart, I promise. This one shows these 1 day big drawdowns. So, recently we've had some days that were really rough in the market. We had some 4 to 5% drawdowns on just a week or so ago. Let's compare that to what's happened in history. So you can see back in 2020 during COVID, we had some days that were down 10, 12%. In 2008, we had a whole bunch of days that were down 6, 8, 9% just in a single day. Brutal, right? When you're like checking your daily account balances. But then what's important is to go one column over and look at what did the market do just 1 year later from those days. And it's astonishing. I mean, just look at these returns. In 2008, we had days down 8, 9%, and a year later, we're up 20, 35%. So the average of just these days here is 1 year later up 30%. And then as time goes on, that number decreases, right? Because when you have these big drawdowns, you also can have these big recoveries and then things stabilize again and we see the more consistent returns that we're used to. But I think it's really important when we have these days of mega volatility and the extreme drawdowns to know, just like we saw last week, you don't know when that recovery is going to come. And as Trevor was telling us, we had a day up 12% that we haven't seen in decades. And so what's important is that you don't miss out on the recovery. And what this chart shows is that typically that recovery is not that far off. And so as Mindy was talking about, if you are confident in your time frame and your goals and you can withstand this kind of volatility, you are going to see those recoveries in your portfolio eventually.
All right, so the last action we're going to talk about that you can take are Roth conversions. So what that is moving money from a traditional or a pre-tax IRA or a pre-tax 401k into a Roth or a post-tax IRA. So you pay taxes on the amount that you convert now, but the money then grows tax-free. Withdrawals in retirement are also tax-free. So it's a strategy we use to reduce future taxes, especially if you expect to be in a higher tax bracket later, which is the goal, right? So to give you an example, let's just say you have $10,000 in your IRA, your pre-tax IRA, and you'd like to convert that to a Roth. Typically, you're going to pay whatever your tax bracket is to convert that into a Roth. If your account value goes down because the market's down to 8,000, now you're going to pay less. So when we actually have a downturn in the market, it's a great time to do some of those pre-tax to post-tax conversions. All right, well, that is it. That's all we provided with you for you guys tonight. So thank you so much again for coming. I love doing things like this because it really shows that you all value your money and your future, and also us. We put a lot of effort into wanting to make sure that you have the education and the tools that you need to make you more successful. So if you have questions that came up or you want to see one of these charts or discuss something in it, please make sure you schedule something or you can email us your questions or text me, whatever is easiest for you. A recording will be sent out for this if you have a spouse or somebody who wasn't able to jump on. And I'd really like to take a minute to thank Trevor so much for coming on and sharing his wisdom with us. So other than that, thank you all so much. Have a good evening. Enjoy your week.